Australian restaurants are going bankrupt at a pace that should scare anyone who cares about small business. Walk down almost any major dining strip on a Friday night and you can already feel it. Venues that used to be packed are half empty, and the shops next door are covered with lease signs and blacked-out windows. The official story is that the economy is still resilient, but for a huge number of restaurant owners, the numbers no longer work. This is not just a bad season or a temporary slowdown. The basic mathematics of running a restaurant in Australia has become brutally difficult. In this video, I'm going to break down the exact triple squeeze crushing the sector, the type of restaurant that looks most exposed next, and the one business model where capital is quietly moving instead. This collapse is not happening because Australians suddenly stopped liking food or going out. It is happening because owners are being squeezed from three directions at once, and the first pressure point is the commercial lease trap. During the boom years, a lot of restaurant owners signed 5-year, 7-year, or 10-year leases with built-in annual rent increases of 4 or 5%. At the time, those deals looked manageable because sales were stronger and confidence was high. But many of those lease terms are still in place while customer spending has weakened, input costs have surged, and margins have thinned out. In many cases, the owner also signed a personal guarantee. That means the business is not the only thing at risk. If the restaurant fails, the owner can end up personally exposed as well. That is why so many operators keep trading long after the numbers have stopped making sense. They are not just trying to save a business, they are trying to protect their own financial future. A lot of people ask the obvious question, why would a landlord not just reduce the rent and keep a decent tenant alive? The answer is that commercial property valuations are often heavily influenced by rental income. If the landlord cuts the rent sharply, it can affect the building valuation, the loan position, and the willingness of lenders to refinance. So in many cases, landlords prefer to hold the line, even if that means a tenant struggles or an empty shop sits dark for months. That is why the lease becomes a trap. Revenue can fall, but the rent often does not. Power bills rise, insurance rises, food costs rise, wages rise. But one of the biggest fixed costs in the business stays locked in or keeps climbing. Owners end up pouring in savings just to stay open, hoping conditions improve before the cash runs out. But the landlord is only the first pressure point. The second is the tax debt time bomb. During the pandemic years, many businesses were given breathing space. Tax debts were deferred, business activity statement liabilities were pushed back. Superannuation arrears built up. For a while, enforcement was softer, because the priority was survival. That period is over. The Australian Taxation Office has become much more active in debt recovery, and that matters enormously for hospitality because so many venues came out of the pandemic already weak. A restaurant can survive a quiet month. It is much harder to survive old tax debt, current tax debt, rising wages, and falling customer spend all at once. This is where things get dangerous very quickly. If a business falls behind badly enough, the pressure is no longer abstract. Director penalty notices can put personal pressure on directors. Garnishee action can hit cash flow. Payment plans can become harder to sustain if weekly sales are already under stress. And when a venue loses access to working cash, even briefly, it can unravel fast. No cash means no stock. No stock means no service. No service means no weekend revenue. That is how a weak business tips into insolvency. The third force is the collapse in discretionary spending. This is where the Reserve Bank of Australia rate cycle hits hospitality directly. When mortgage repayments jump, families do not just spend less on major luxuries. They cut back on everyday treats first. The extra money going into higher repayments, rent, insurance, groceries and utilities is money that no longer goes into casual dinners, coffees, desserts, drinks and impulse meals out. That shift changes the whole restaurant economy. The customer who used to eat out 3 times a week starts going once. The customer who used to buy drinks and dessert now orders a main only. The family that used to spend freely on a midweek dinner now looks at the menu and decides it is cheaper to cook at home. That creates a brutal mismatch. Because costs have risen so much, the restaurant may need to charge $30 or more for a basic meal, just to protect a thin margin. But a customer under pressure may only be willing to spend $15 or $20. The owner cannot cut the price enough to stimulate demand, and the customer cannot spend enough to make the venue profitable. That is when the model starts to break. But this crisis is not hitting every venue the same way. There are 2 parts of the market that look especially exposed, and one of them is probably your favorite local spot. The biggest casualty is the middle-tier suburban restaurant. This is the neighborhood Italian place, the reliable Thai restaurant, the local bistro, the venue that charges enough to feel like a proper meal out, but not enough to be a once-a-year event. For years, that segment was the backbone of Australian dining culture. It was where families went when they did not want to cook. It was where couples went on an ordinary weeknight. It was where birthdays, catch-ups, and easy dinners happened without too much thought. Now it is stuck in the worst part of the market. It is too expensive to be treated as cheap convenience, but not special enough to justify as a major splurge. These venues rely on regular volume. They need midweek trade, solid weekends, and enough table turns to cover rent, staff, and spoilage. When that volume drops, the damage is immediate. The room feels half full, but the margin disappears. Food gets thrown out. Staff hours become harder to justify. 1 week month becomes 3. Then the owner starts making impossible choices. The second vulnerable category is the high-end central business district restaurant. These venues often carry huge rents, large floor plates, expensive fit-outs, and bigger staffing costs. A lot of them were built around a world of busy offices, corporate lunches, client dinners, event spending, and 5-day city foot traffic. That world has changed. Hybrid work has reduced weekday density, corporate budgets are tighter, many businesses entertain less than they used to. That does not mean fine dining disappears. But it does mean that large city venues built for constant weekday volume can become very hard to justify. If a restaurant is only truly full on Friday and Saturday night, the rest of the week starts to look like a very expensive problem. A beautiful venue with empty seats is still paying premium rent, and when restaurants close, the pain does not stop at the kitchen door. It starts moving through the wider commercial property market. Most people see a closed venue and think the food must not have been good enough. The deeper problem is that an empty hospitality site also means lost rent for the landlord and weaker income for the building. If a shopfront stays vacant for months, the street loses traffic. The next operator gets fewer passing customers. The neighboring business weakens. Then another tenancy goes dark. That is how local strips deteriorate. One closure reduces the energy of the area. Less energy means fewer people. Fewer people means weaker trade for everyone else. Over time, the whole street starts to feel unstable, and that is when investors, landlords, and lenders all start paying closer attention. So what does this mean for you? The answer depends on whether you are a customer, an operator, or an investor. If you are a customer and you actually want your favorite local venue to survive, the biggest thing you can do is simple. Support them directly. Third-party delivery platforms can take a very large cut of the sale, and for a restaurant already working on a thin margin, that fee can wipe out most or all of the profit. If you want a local business to keep more of the money, dine in, call directly, or pick up the food yourself when you can. If you are an operator, the uncomfortable truth is that the old full-service middle-market model is now much harder to defend. The winners are increasingly moving to the edges. On one side, there is ultra-convenience. That means low overhead, fast service, tight menus, strong takeaway economics, and minimal floor space. Think specialist bakeries, focused takeaway counters, premium coffee windows, and businesses built for speed rather than seating. On the other side, there is experience-driven premium dining. These are destination venues that do not compete on convenience at all. They compete on occasion, status, atmosphere, and uniqueness. They serve customers who are less sensitive to everyday cost pressure and more willing to pay for a memorable night out. What is struggling most is everything in the middle. The places trying to do full-service dining for ordinary households in ordinary suburbs at a price point that now feels expensive but not exceptional. That is where the pressure is most intense. If you are a commercial property investor, caution matters. A retail asset that depends heavily on a single hospitality tenant can look very different in a downturn than it did in a boom. If the operator is weak, the lease is not a shield. It is only strong until the tenant breaks. After that, you may be left with vacancy, incentives, fit-out costs, and a much longer reletting period than you expected. The smart money is not leaving food completely. It is becoming far more selective. It is moving toward businesses with lower fixed costs, tighter operations, and clearer demand. It is also favoring concepts that either deliver convenience very efficiently or offer a premium experience people cannot easily replace at home. The Australians who lose money in an economic reset are often the ones who look at an empty restaurant and assume the food was bad. The ones who protect themselves are the ones who look at the empty room and understand the numbers behind it. What is happening in hospitality right now is not just bad luck. It is the result of pressure from rent, tax debt, wages, utilities, and weaker consumer spending all hitting at the same time. This video is for general information and commentary only. It is not financial advice, legal advice, tax advice, or business advice. Always do your own research and speak with a qualified accountant, lawyer, advisor, or industry professional before making any business or investment decision. If this video opened your eyes to what is really happening in Australian hospitality, tap like so more people see it. Subscribe, because this economic reset is spreading into other sectors too. And we are going to keep following the numbers. And tell me in the comments which local restaurant in your area has shut down recently, because those ground-level stories show how fast this is moving.